Welcome to the New Wealth Wave podcast hosted by Dr. Joaquin Wallace. We're diving deep into the intricate layers of the 7-stage generational wealth model to offer invaluable insights on legacy building, wealth accumulation and preservation, and financial growth across generations. I'm Dr. Joaquin Wallace, and this is the New Wealth Wave podcast. Hey, future wealth builders. Welcome to another episode of the New Wealth Wave podcast. Today, we will focus on stage 6 of my 7-stage generational wealth model. Leading the discussion will be Martin Johnson, the founder of Johnson's Law and Tax, a firm dedicated to providing comprehensive estate planning and tax planning services, as well as tax preparation. With extensive experience in both fields, Martin and his team specialize in helping clients navigate the complexities of estate and tax laws to secure generational wealth. So if this is your first time tapping into the New Wealth Wave podcast, make sure you hit the subscribe button below and you can get all of the notifications on our up and coming podcast episodes. But if you are a future wealth builder, you know the gentleman that's in the studio is Martin Johnson. Because in 2024, Martin had the #1 viewed podcast on the New Wealth Wave, and he was top 5 in his second one. Episode number 4 was #1. In fact, that was our first ever live podcast, podcast that we did with Martin. And number 14 came later on, and that was equally impressive as well. So Martin, how you doing? And welcome to New Wealth Wave podcast.
Thank you very much. It's a pleasure to be back on the show, and I am honored that my episodes have done so well on your podcast.
Well, you drop a lot of information. I tell you what, it's one of those type of podcasts when people listen, they wind up doing this here, they wind up scratching their head and saying, okay, I need to take care of business. As we know, generational wealth begins with generational knowledge, and your podcast basically touches upon that itself. So again, if this is your first time tapping into the New Wealth Wave podcast, make sure you hit the subscribe button because the podcast is based on my 7-stage generational wealth model. And you may say, what is the 7-stage generational wealth model? Well, I'm going to explain it to you in detail. So stage 1 is our internal and external ecosystem. Stage 2 is our financial genetic code, which we focus on financial trauma, financial anxiety. Stage number 3 is financial healing, where we provide you tools to help you reprogram your financial genetic code, which is a byproduct of stages 2 and 1. Stage 4 is financial edification, where we focus on financial literacy and financial inclusion. Stage 5 is financial well-being. This is where we're all trying to reach. This is where we're focusing on not outliving our income and making sure that financial health is financial wealth. And stage 6, where Martin is leading the discussion today, is generational knowledge, which creates your financial footprints, which is so important because that leads you to generational wealth, stage 7. So again, Martin, this is the second time on the show. And if you want to go back and kind of get a view of where he was at on the model itself, you can go back and check out episodes 4 and 14. But again, Martin, for the first time listeners, a couple of years back, Martin, we talked about the model. What was your initial thoughts on the model?
Well, my initial thoughts were that it was the first time I had seen in one cohesive model someone trying to address all of the issues that go into financial literacy, financial education, dealing with our past, dealing with just how we grew up, and the whole piece of passing it on to future generations. I've seen bits and pieces of your model here and there, but I've never seen all of the concepts in one place. And that's the thing that I love about your model and how you're trying to address so many different issues.
Appreciate that. Again, the model is based on some behavioral financial theory as well as some traditional financial theory as well, because we know that many of our decisions that we make, our relationship with money is emotionally driven. Unbeknownst to us, all of those past heretics that we speak about, there are mental shortcuts that we have, the cognitive biases that come into play. It's really what drives a lot of our decisions in regards to money. And we fail to look at the traditional finances, which looks at the fundamentals, which is stage 4 in regards to inclusion as well as literacy. So let's get into some tax planning. So I was on vacation a couple of weeks ago, and one of my wife's friends, it was her birthday. and we're around the table later on just talking, and we're all either Gen Xers or baby boomers. And it was interesting because people were talking about retirement. It was like, we're at a birthday party, but we're talking about retirement because we're getting to that age. And I mentioned to them, we're all trying to get to stage 5, which is financial well-being. And it was an interesting question I asked, how many of you have an estate plan? And out of the room, between all of us, only one person, which is myself and my wife, had an
Wow.
estate plan, and the estate plan that you actually created. And it was interesting because it's so many misconceptions that go into
Right.
why they don't have an estate plan. So, with that being said today, why is estate planning so important in today's climate?
Estate planning is more important than ever, particularly with what's going on with the rising cost of living. There's tax law changes and family dynamics. All of these things can complicate an inheritance. It can complicate what you're trying to do to leave your assets for your heirs or the next generation. And so we talk a lot about the number one thing is probate avoidance. That's still important. It was important 10 years ago. It's important now, and it'll be important 15 years from now. Protecting your beneficiaries, particularly those who are minors or beneficiaries with special needs, and also the overall goal of reducing family disputes. All of these are reasons why estate planning is particularly important today.
We talk about stage 6 of the generational wealth model, generational knowledge. And again, the phrase generational wealth begins with generational knowledge. How does that phrase actually coincide with estate planning, stage 6 of the model?
A well designed estate plan is not just about who gets what when you die. It's really about passing down the assets, but also the financial knowledge and the values of the family. And so when you talk about a well designed estate plan, part of it is communicating to your heirs why you put this plan together, what your intentions are, and the fact that you're trying to educate them and teach them so they can do it for their heirs. And this is where the whole generational knowledge comes in. So with generational knowledge, you can obtain generational wealth. But without that knowledge, the wealth is going to disappear within a generation.
What are some of the finer points that you have within an estate plan that people may overlook? We're speaking of people who actually have an estate plan. What are some of the finer points that they may overlook?
Well, one thing I want to say, and we talked about this during the first session, is that there's a difference between a formal estate plan that you intentionally put together versus the estate plan that the state of California has for you. And that's for anybody who doesn't get up and put their own plan together. The state has something for you. Gavin Newsom has something for you. And whoever the next governor is, they have something for you. So with that being said, for those who have actually been intentional and put an estate plan together, some of the finer points are this. It's not a set it and forget it type of plan. You do have to update your plan because beneficiaries may move, they may pass away, they may have disabilities that affect them. So you need to adjust your plan for those type of things happening. We hate to hear about children dying before their parents, but that can happen. And so if you don't update your estate plan after the death of a loved one who's in the plan, that's an issue. Planning for incapacity. So some people say, well, I don't have an estate plan. Why do I need it? I don't have a lot. What if you become incapacitated? You're here on earth, but now someone has to go to court to get a court order to help continue to provide for you and do things for you because you didn't put it in place through powers of attorney or healthcare directives and that sort of thing. Another thing is just the titling of assets. Some people put estate plans together, but they're not done properly. And I can't tell you the number of times, doctor, that we find out that someone had a trust, but they never transferred their home into the trust. They never transferred that raw land into the trust. So those assets go through probate and they end up in the hands of people that were not intended to get those assets.
I want to touch on the probate because we talked about it in our first episode. I believe we touched upon it in our second episode. And I think it's so important that we have to touch upon it in this episode as well,
Okay.
too. So explain to the listeners the cost of probate because it is a cost. And many people don't see that as a hidden cost that's within itself and how that can affect you, the person, the beneficiary, if you will. How does probate affect you?
First of all, the purpose of probate is to transfer assets of a deceased person, whether they have a will or no will. So let's just use a house, for example. A house is in your name. You end up passing away. How does that house get into the official name of someone you want to leave it to? Either through a trust, it's done out of court, or through probate, and it involves the legal system. It involves the probate court. So it's a legal process where the county takes an assessment, an inventory of your assets, and based on the total gross value of those assets, there's a statutory fee applied to those assets. And it's a progressive approach where it's 4% of the first 100,000, 3% of the next 100,000, and then 2% of the next up to 800,000. And then there's percentages for money past that. But to give you some context, in California, on $1 million gross probate, you're looking at $46,000 of legal fees minimum. That's just the statutory fee. There's additional costs that you'd have to pay an attorney. So you're probably going to get up to about $50,000, $55,000. That's the cost of probate. Now, we throw in the additional time. In Contra Costa County, there's over 1,500 or so probates open right now. It's going to take about 4 months to get to the first probate hearing. Then there's 4 months. That's the time for creditor claims. So there's a 4-month period where creditors can come forward, and that includes the Franchise Tax Board, the IRS, anybody else who you left owing money to when you die. After that 4 months, then whoever is your executor or personal representative can then apply to close the probate. That's going to take another 4 months. So you're at a year by the time you can close the probate. And if the house has a mortgage on it, it still has to be paid. And who's going to be paying that? So these are some of the minor issues in probate. We haven't even talked about some more complex issues in probate.
Martin, I see now that you rebranded yourself. You added in the tax portion of it as well. Now you call Johnson Law and Tax, which is important because tax does play a huge piece in estate planning as well as creating generational wealth. So with that being said, how does tax considerations come into play when setting up an estate plan?
Well, one of the things that we do with estate planning is we really try to look at, first of all, will your estate end up having to pay estate taxes? And currently the threshold is so high that the average person is not going to have to pay estate taxes. So then the next thing we look at is income taxes to the heirs. Now, we do know that inheritances generally are tax-free. So if you leave a gift to someone after you die, they get that gift tax-free. But the problem that happens with estate planning, particularly when you're looking at real estate and securities, is that a person may die on January 1, but it could take several months before that asset is actually distributed out. During the time between the death and the distribution, those assets could be growing and there could be some capital gains tax associated. So we try to put in place plans to minimize that period through a living trust versus probate. So that minimizes capital gains. Another thing that can be done through estate planning is avoiding a big capital gain when real estate is left to someone. In the Black community, there's so many stories of people who say, grandma put my brother and me on title to her house because she didn't want to lose the house when she dies. My dad just put me on the title of the house. Well, when that happens, you really have blown it when it comes to tax savings. And I'll give you a quick, short example. Let's say grandma bought the house for $50,000 back in 1950. Grandma's house now in West Oakland is worth $1 million. Well, If grandma leaves that house to you and passes it on to you through an estate plan, a living trust, when she dies, the value of that house in the eyes of the tax man goes up to $1 million. So if you sold that house the next day, that $1 million would be tax free to you if you got it through a living trust, an inheritance. But if grandma adds you to the house 4 months before she dies, and then she dies, guess what? You get the house with a $50,000 value based on the value grandma bought it at. And now you turn around to sell this $1 million house and you have a $950,000 capital gains bill because you didn't have generational knowledge passed on to you about how to do proper estate planning.
That's so important because we talk about, generational wealth begins with generational knowledge. And we're not just talking about assets, as you mentioned earlier. We're talking about the educational piece of it all, because that's where we're pretty much behind the eight ball. And again, stories like that, which you just mentioned, is something that happens throughout, whether it's in marginalized communities, whether it's in other type of communities as well, because that's information that we just don't know, because we
Right.
feel that, hey, the house is in our name, but you're not looking at the stepped up value, as you mentioned earlier, cost basis associated with that,
Mhm.
which is so important. You're looking at securities as well, whether it's inherited, whether it's gifted to you. You have those stepped up bases that you may have to pay if you sell those securities. So, all of those things are so important. And I'm glad that you were able to kind of touch on that as well. Future Wealth Builders, we are excited to have Martin Johnson, founder of Johnson Law and Tax, a firm dedicated to providing comprehensive estate planning, tax planning, and preparation services, on our podcast today. You can find us on Apple, YouTube, Spotify, and all the major social media platforms. Make sure you hit the subscribe button. You can get more information such as this, because this is where generational wealth begins with generational knowledge. What are some common tax planning strategies that can benefit the average person?
Couple of things. First of all, proactive tax planning can significantly reduce a person's lifetime taxability. One of the problems that I see quite often is people are not having enough taxes withheld from their paychecks. And so what that ends up doing is causing them to face under withholding penalties. And when their taxes are due, they have a very large tax bill. And if they don't have the resources to pay that bill, they end up going on an installment plan, or many people put their heads in the sand and don't pay the taxes. I recently worked on a probate case where an older man died and owed over $75,000 in income taxes. So that's one thing, making sure you're having the right amount of withholdings taken out. And it's good to do an analysis of that early in the year by basically doing a projection to see, if I stay on this pace with my income, I'm going to make, $200,000, but I'm only having, 20 grand taken out of my check. You're going to end up with a big bill. So that's one thing I would do. The other thing is, I don't think people take advantage of their 401ks and their employer sponsored retirement plans. They don't set up their own IRAs through financial advisors like yourself. The other thing they could do is what we call bunching deductions. And this is holding your charitable contributions until you get enough of them to a point where when you make a large donation, it's actually going to help you tax wise. Since the first Trump administration, when the standard deduction was raised, there's so many people who contribute to church and other charities, but the amounts are so low, they never surpass their standard deduction. But if you were so inclined, if you give 5, 10, 15,000 a year, if you held on to that for 3 years, you got 30 grand now and you contributed, it not only makes a bigger impact to the charity, but it may help reduce your tax burden. And, that can be kind of tricky, particularly if you're talking to pastors about holding those ties for 3 years. They don't like that. They want their money every week. Another thing is tax loss harvesting. If you have a portfolio of stocks, some of those stocks go up, some of them go down. Being proactive in November and December, taking a look at your stocks that have losses, maybe it's time to sell those to offset some capital gains in your portfolio. So those are just a few things that average people can do to reduce their tax liability.
Also, too, on that journey you're speaking of, there's a significant difference between long-term capital gains when you have stocks as well, because if you have a stock that's over 1 year, then you're considered long-term capital gains. If you purchase and sell it within 1 year, then it's short-term capital gains, which is more costly than long-term capital gains as well. So again, these are conversations that, bringing a person in like yourself to kind of lay the foundation, educate individuals, allow them to make the right decisions going forward definitely does play a huge factor in creating generational wealth. I have a question for you though. What drove you to rebrand your organization, including tax, a byproduct of it all? Because before you was really focused on law and estate planning, but you did tax preparation. So why the change?
Well, some of it had to do with some regulatory issues, but primarily what I was doing, I had a set of clients who were estate planning clients, and I had some tax planning clients. And over the years, I just found out that, people who do their taxes, they need estate planning, and people who have estate planning need their taxes done. And there's some synergies that come when you have everything done under one roof. So generally, if I'm working on an estate plan and someone has their own CPA or tax planner, I need to communicate with that person about the type of trust we've created and some of the implications that I see that could be going on with tax. When I'm the same person doing the tax and doing the estate, I also offer bookkeeping services. When all of that is under one roof, I have a more comprehensive knowledge of what's going on, and there's less of a chance for something to fall through the cracks. Actually, there's no chance for anything to fall through the cracks about a particular deduction or something that's going on in a person's finances that could impact both their estate and their tax life.
I like that answer because, I've mentioned to you that I would like you to use those services with me and my family, as well as the businesses that we have, because it's important to have everything under one roof. I do believe many people don't want to diversify it, but I do believe if you can have one person that can have an idea, as you mentioned earlier, the client, you know exactly what they need, and you're able to provide a more comprehensive plan. For myself, I'm licensed to do property and casualty. I'm licensed to do HMO plans as well, disability, long-term care, life insurance, security. So many of my clients that I have their entire portfolio. So it's a one call. They call me, they need to get some property and casualty, car insurance, whatever the case may be. I can make those moves and decisions because they're comfortable with me, as you mentioned earlier, with yourself. So Martin, if you are a LLC, sole prop, S or C corp, how does proper tax planning help mitigate potential tax issues?
Each of these entities has different types of tax obligations, and planning ahead can definitely prevent overpaying taxes. LLCs and sole props are subject to some self-employment tax that can be really high without proper deductions. So we could do some planning around that. When it comes to S corps are supposed to take a reasonable salary. And a lot of times I see S corp owners taking way more salary than they should. They should be taking most of that money through distributions. So we have to kind of work around what is a reasonable salary for this particular role. And then, of course, with C corps, you have this issue of double taxation. So generally for small businesses, I would say LLC or S corp is the way to go. I really wouldn't mess with a C corp unless there was some circumstances that would make that a more beneficial organizational structure.
So a question for you. I mean, you talked about S Corp, C Corp, sole prop, LLC. Most people have an LLC or a sole prop. But if you do have an LLC, in your estimation, your expertise, when will it be advantageous to use an S Corp designation when you have an LLC?
Generally, when you have income or revenue exceeding, I'd say $50,000 or $60,000. Because there's going to be some costs in getting the S classification set up and making sure your structure is correct. And then to determine the salary that's going to be appropriate for you. If you're not making any money in the business, you may not be able to even take a salary. And that's a requirement of an S Corp structure. Even if you're an LLC being taxed as an S Corp, you're required to take a reasonable salary. And that's where a lot of people go wrong, forming S Corps before there's really enough revenue coming into the firm.
So $50 or $60,000 in terms of revenue with an LLC would probably be advantageous to utilize the S corp tax designation. But again, a lot of the hidden costs that we don't take into account, as you mentioned earlier, it may be more costly to do that as well, right?
Yeah. And, I have a good example. I have a client who found herself out of work only because the company was going another direction, very successful professional. And so she ended up doing what she was doing as a profession, but in her own business. Well, the first year she did it as a sole proprietorship and she got killed with taxes. I did an analysis for her to see if bringing in that same money, if she was an S Corp, how it would have come out. And in that first year, she would have saved about 12 grand in federal tax. So she was convinced. We set up the S Corp, and now going forward, she's loving it. Lower taxes, but she's been able to put more money away in retirement plans and that sort of thing. So it just doesn't make sense if you're not making 50 or 60 grand or more, because you really should have an accountant working for you. There's a lot of things that should be put in place, and it's going to cost money to get those things set up. And unless you're willing to pay that money and get it set up, it doesn't make sense to change your organizational structure.
Great point. So when is the filing period for LLCs, S Corp, and C Corps?
C Corps is April 15th. LLCs that are partnership LLCs is March 15th. If you're a solo LLC, you still have until April 15th. And S Corp is March 15th.
So if you're not able to meet those deadlines, you are able to extend.
Yes, you can file an extension, and it is an extension for filing only, not the extension to pay. So if you do owe money, you should pay it on March 15th if that's your due date, or April 15th. But for S Corps and LLCs that are taxed as partnerships, they have the extension to September 15th, and individuals, C Corps, can go until October 15th with the extension.
For our first-time listeners out there, could you give just a brief description of the difference between a sole prop LLC and a partnership LLC?
A sole prop LLC is what we call a single member or a single managed LLC. So it's just you. We also call that a disregarded entity. So that LLC can file on a Schedule C on the person's individual tax return. So you have a Schedule C for a sole prop, but you also have a Schedule C for a solo LLC. So both of those are filed the same way. The difference is that the LLC is still going to pay the $800 annual California franchise tax annual fee, even though they're not filing a separate LLC return at the personal level, but there is a state LLC return that has to get filed. Hopefully I didn't confuse you on that.
No, that's fine. Okay. So, Future Wealth Builders, we're excited to have Martin Johnson, founder of Johnson Law and Tax, a firm dedicated to providing comprehensive estate planning, tax planning, and preparation services on our podcast. This is Martin's third time on the New Wealth Wave. He had the #1 viewed podcast in 2024. He had 2 top 5 podcast episodes as well, and his shorts did extremely well. You can go back and tap into those, hit the subscribe button, or you can just go back and tap in. You can find us on Apple, YouTube, Spotify, and all of the major social media platforms. So, Martin, how can estate planning help reduce potential tax burdens on beneficiaries?
Well, we talked about one of them already, the whole step up in basis on inherited property. If you inherit property when a person dies, the principal money that you receive is not taxable, only gain on that money. And this is kind of hard for some people to grasp. Once again, let's say grandma dies and she leaves you $50,000 in cash. That $50,000 is tax-free. It's an inheritance. It's a gift. But if that $50,000 is left to you and grandma leaves it in a trust and there's some administration that has to take place, or let's say it's in probate, she leaves it in cash, but it's in probate, the interest that money earns or grows between the time grandma dies and the time you get it, that piece is taxable. So if it earns, 4 or 5 grand of interest, that's taxable, but the 50,000 of principal is not. So making sure that you get inheritances through death is going to keep you out of the tax bite, let's say. Another thing that can be done is gifting strategies. We can work with family members to maybe gift during lifetime, but we stay below the annual gifting threshold. So right now you can give $19,000 per year to any individual you want without gift tax. So you could give 19, your wife could give 19. If you have 5 kids, you could give 19,000 to each of them with no gift tax, and there's no tax to them. The problem becomes when someone says, you know what, I'm going to give my son $200,000 down payment to buy a house. Well, that technically is a taxable gift because it's over the $19,000. So there's some strategies that if you have the knowledge, you can avoid some of these problems. Another issue is whether or not you have a properly structured trust. Irrevocable trust can remove assets from your estate and reduce estate taxes. But as I said earlier, very few people these days are above the threshold, which is about $28 million. So as long as you're below that, you can leave all of that money to your heirs without any estate taxes.
That's something I need to concern myself with because I'm at 28 million and five. So I'm over that number. So I have to definitely
Yes.
reach out to you to help me strategize properly. So
And I just want to say that this also speaks to the whole issue of why so few people do estate planning, because they think it's only for the ultra wealthy and the rich. But as we've discussed earlier in the episode, if you have a house in California and the average house nowadays is in the 700 to 800,000 range, you need some estate planning or your heirs are going to lose out on money that's going to go to the state or the courts.
I got a question for you in terms of gifting. So you have a married couple, and let's say one person within the marriage is reaching out and going to purchase a home without the other spouse. That person gifts the spouse X amount of dollars. Do the taxes play similar to that of gifting to a relative or a beneficiary versus to your wife or a husband?
That's a good question. And I think we have to also throw on top of it a layer of community property law here in California. Because let's say you gift your wife $50,000, it could be argued that that's probably only $25,000 because in a marriage in California, most of the money coming into the household is community property. But technically, if you gift more than $19,000 in this year, it's subject to gift tax, and the tax is payable by the person making the gift, not the person receiving the gift. So, that's the first time I've heard that question, Dr. Joaquin. I'll have to dig into that a little deeper. And I understand where you're coming from. It's like, well, if I gift to my spouse, is that different than gifting to someone who's not my spouse?
It happens. It happens.
And you need to get a family law attorney on the episode as well. Not this episode, but another episode.
Well, if you have one in mind, definitely like to get that person on because we try to touch all the areas.
I think, I really think that would be a good episode because the old saying, it's cheaper to keep her. A lot of brothers don't believe in that, and then they find out the hard way after they've gotten a divorce. And I think having a family law attorney on one of your episodes could educate both sides, male and female, to the disadvantages of dissolution where you could go get some counseling and keep your stuff together.
Listen, we talk about therapy, we talk behavioral, we talk about everything on this podcast that focuses on generational wealth. So definitely, if you have someone in mind, please do forward me their information. So what should people know about tax implications when creating a trust?
Generally, once again, the average person, and when I say average, you could be making $80,000 a year, you could be making 200. Even if you're making $2 million a year, this would apply. That revocable living trusts do not have any kind of tax benefits. All it does is help you avoid probate. It makes sure that your wishes are carried out clearly, and it avoids family disputes. It reduces family disputes, and it also can help with capital gains reduction on gifts being left. When it comes to irrevocable trust, there are some tax implications there because you are actually going to be creating a trust and removing assets out of your name and putting them into an entity that you no longer control. But that's done to save massive taxes at the estate tax level. And the reason why estate tax is important to those who have to pay it is because the tax is 40%. So if you can get below that 28 million, you're going to save 48% of whatever was above that 28 million. Those are the main things that you have to think about when it comes to estate planning and taxes.
So, Martin, how is tax preparation different from tax planning, and why is each of those important?
Tax prep is focused on compliance, making sure you comply with the law by filing tax returns at the federal and state level. And so many people, when they first come to me, they think that, hey, I need somebody to do my taxes. I'm paying too much in taxes. Well, preparing taxes, doing your taxes is not going to lower your taxes other than if I can see deductions that maybe you're not taking advantage of. So tax preparation is just filing taxes for you. Tax planning is what's done after April 15th and before December 31st. And if you're really good about it, you should be doing tax planning at least on a quarterly basis. Tax planning is looking at income that's possibly coming in this year, bonuses that you might get, things you're thinking about buying for your business. There could be deductions. Maybe you decide to buy it in December versus buying it in January because of the income you've made that year. That's what tax planning is about. It's about how can we lower our taxes, being proactive and thinking about all the transactions we're going to do this year versus you wait till January 2nd, the year's over. We cannot go back and retroactively tax plan. And that's the difference.
Question for you again. So, what are specific tax deductions or credits that people often miss during tax season?
People often miss some of the smaller things. Student loan interest is deductible. You don't have to itemize your deductions for student loan interest. People often miss the fact now that the standard deduction is so high for individuals and married couples, they say, well, why should I even fool with tallying up my medical expenses, my co-pays, my dental visits? And, I only contribute a certain amount to church. Why should I tally all that stuff up? Because I'm below the standard deduction that the government gets me. The answer is those deductions could still be beneficial at the state level, even though they're not deductible at the federal level. So that's one thing. The other thing is maybe if you have a business and you work from home, maybe you're not taking advantage of a home office deduction. If you have an S Corp, there's some other ways we can deduct the use of your home office that can be quite significant. If you have solar panels that you've put on your home, or you've done some energy efficient upgrades to your home, a heat pump, there were 30% tax credits for solar. So if you spent 30 grand on solar, that's going to get you $9,000 of tax credits. So there's a lot of little things that people overlook because, first of all, they're trying to do their own taxes. And I would say once you're over about 100 and 125,000 a year, you should probably have someone else do your taxes. Then you throw in, you have some real estate, rental property. And then if you have a small business, you should probably have someone doing your taxes, and you should have a bookkeeper. If you run a business, you need to have a bookkeeper.
Yeah, I agree with that. So, we talk about stage 6 of the model, which is generational knowledge. From generational wealth begins with generational knowledge. Stage 4 is financial edification, where we speak about financial literacy and inclusion. But one area that we often overlook in particular stage 6 is the importance of having life insurance. I mean, it's so important to having that. I had this conversation at the birthday party, who has life insurance and the purpose of having it. It's interesting that so many people still don't really know the difference between term and whole life. It's like a big difference. And everyone talks about whole life, but you have index, you have variables, you have universal life.
Right.
You have different types of life insurance policies that you do have that can build cash value and things of that nature. You can add riders on for long-term care or chronic illnesses, things of that nature. But with that being said, what does the role life insurance play in estate planning from a tax perspective?
Well, from a tax perspective, once again, for your average listener, it doesn't play that much of a role. But life insurance plays a very important role when it comes to liquidity during estate administration or trust administration. So, somebody dies, they have a mortgage and they didn't do an estate plan. Now the house is in probate. Who's going to keep paying the mortgage? Now, of course, if it's a husband and wife and they own the house jointly, it's going to automatically go to the surviving spouse. But life insurance could make sure that that spouse has the option to decide to either stay in that house or sell it versus not having an option because there's no life insurance and they can't afford the mortgage payment on one salary. So now they got to sell the house. So it becomes particularly important for liquidity purposes. For those people with large estates, life insurance can play a role of paying estate taxes, basically pennies on the dollar. You can buy $1,000 of life insurance for mere pennies. And I know you talk to your clients about that kind of thing. Business owners could use life insurance for buy-sell agreements. So let's say there's 2-3 people in business. One of the key people dies. And now what are the other 2 people going to do with the share of the person who died? Well, you might have a spouse of the deceased person coming in and saying, hey, I want my 1/3 of this business, or I want to help run the business, where life insurance can fund a buy-sell agreement and a buyout to buy that spouse out of that third share to get them out of your hair so you can continue to run the business. Life insurance can create wealth. It can stop the cycle of people having to go get money to bury folks and that sort of thing. Once again, for pennies on the dollar, you can leave $500,000 to your kids. You can leave $1 million to a kid. That's life-changing and creates the chance for generational wealth. I'm a big believer in life insurance, but it's gotten a bad rap. I think estate planning hasn't gotten a bad rap, but it's just people don't know. They're not educated. And I think we as people of color have been bamboozled and scammed so much in our past that we have this trauma of, I don't want to pay for professional services. I don't want to pay for advice. But what ends up happening is people have to end up getting advice after they've made a mistake or they're in tax trouble or now they're in probate court and they just didn't do themselves any favors.
And we talked about when we started the podcast in regards to what the model is framed around the past, present, and the future, but basically behind the emotional aspects in terms of our relationship with money, a lot of the cognitive biases that we've inherited unbeknownst to us, versus looking at it from a traditional financial theory, which basically suggests doing your due diligence, making sure you're looking at the fundamentals,
Right.
and taking a longer view of things versus in the short term. But you can have some short-term philosophy as well as long-term. You can create a portfolio that can have both short and long-term at the end of the day, but mostly, following the fundamentals versus the heretics that's involved. We have mental shortcuts and people making decisions, things of that nature, FOMO, fear of missing out, chasing the latest, greatest thing that's out there. We find, as you mentioned earlier, a lot of the trauma that has been given to us, unbeknownst to us. Stage 2, we talk about financial trauma and financial anxiety and creating your financial genetic code. So with that being said, can you share some tips for organizing financial documents to make tax preparation an easier process?
Get a shoebox and throw all your receipts in it. No, I'm kidding. I think that organization can reduce anxiety and it can make tax prep easier and more efficient. So if you are still a person who pushes paper, I would get a big envelope or a folder or several folders and put your tax documents, 1099s, W-2s, certain receipts, anything dealing with taxes in a folder for that particular year. And you should be collecting these things all year long. If you have a small business and you're writing off auto expenses and you take your vehicle in during the year, save the receipt, put it in the tax folder right then and there. If you have more computer skills and you're computer savvy, like I would create an electronic folder for the 2025 tax year, and I would start downloading PDFs and scanning documents in for that. The other thing is when you are given a tax organizer from your CPA or your tax preparer, generally these organizers have checklists and questions. Don't underestimate the power of answering those questions and checking, because they're there to elicit whether or not you will be eligible for certain tax deductions or exemptions and that sort of thing. So always fill out the organizer, have your documents organized. And it's a pet peeve of mine. I think if you have a small business, or if you are a professional earning over $100,000, you need a real legitimate scanner in your house. Don't take pictures on your cell phone. Have a scanner. When important documents come through, scan them into your computer, scan them up to the cloud, and you're going to be much more organized. I would also say, doctor, use accounting software. If you have a small business, use QuickBooks or something to the equivalent. For your personal expenses and finances, I would use Quicken or some other kind of personal accounting software. And then be sure to separate business and personal expenses. I can't tell you the number of times people come in and it's for a small business tax prep, and they have their personal credit card is used for business expenses, and they don't have a dedicated card for business. And that creates problems when it comes to the IRS. If you get audited, well, why were you using your personal credit card? That sort of thing. So keep those bank accounts clean and have your books done on a monthly basis if possible. Those are all things that can help for organization.
One of the final questions I'm going to ask you, but imagine a person comes to you, they listen to this podcast, say, hey, I like what Martin's talking about. He can do my estate plan. He can do my taxes. He can do bookkeeping as well. We're January 2025, going into February 2025, haven't done any of that in 2024. He comes to you and say, hey, Martin, I would love to utilize your services. I haven't done anything that you said I should have done in 2024. What do I need to do? What can I do to bring you on to help me in terms of bookkeeping moving forward to 2025? What would you tell that person? Is it easy to do? Is it something that they like, I don't want to do? Talk to me about how easy that may be, because again, people listening to this may say, hey, I'm that person. I want to utilize your services. Can I come to you? Are you going to be, financially shaming me, so to speak? How are we going to be able to work together where I feel comfortable enough to provide you that information? I know you're going to give me the slap on the wrist, but tell me, is it easier said than done?
This is a fantastic question, because there are probably people out there who say, man, I know I need help, but I'm too embarrassed. My stuff isn't together. What should I do? And this is a perfect question. So first of all, I would say set up an appointment. We could do a Zoom or in-person appointment. We talk about what your situation is. And if you have a small business, the one thing I would say is, okay, let me take a look at your financial statements. Oh, you don't have any financial statements. So the first thing I would say is, let's do a cleanup. Let's clean up 2024. And if you only have bank statements and receipts, someone on my staff can put together, we'll set up a QuickBooks account for you. We'll get those transactions entered. We'll get those receipts entered, and we'll work with you to clean it up so that we can file your taxes. And so you're not another year behind. I mean, I've had people come to me who haven't done their taxes in 3 or 4 years. So we'll get you cleaned up, and then we'll start you on the path of, okay, now we're going to do your books for 2025. We got you cleaned up for 24. We're going to do your books for 25. We're going to schedule a couple of quarterly meetings here and there so that by 25, all we got to do is push a few buttons and we're good to go. Cleanup is going to start at a minimum of $750. That's going to allow us to get everything for the previous year, get your books cleaned up, and that's just cleanup, and then we can prepare taxes. If you say, hey, I want cleanup and I want ongoing accounting work, that's generally going to be about $500 a month. We get you set up on QuickBooks. We get all the chart of accounts set, the categories, and we tailor that to your business. And then we do your books every month. So every month you're going to get financial statements, a balance sheet, some key insights, and you'll get some advice along the way. For an individual, generally all we need is to see their last couple of years of tax returns. I would give them the individual organizer. I would tell them to give me the document documents you have from the taxing authorities or your banks, like, the 1099s, the W-2s, those type of things. At the individual level, it's a lot easier if you aren't that organized. But when a business isn't organized, we have to do some triage, cleanup work first before we can start working. I don't do any financial personal shaming of people who come in. I've been in their boat years ago. I see people like this all the time. And it's all about, okay, what are we going to do going forward? We don't harbor on the past.
You're in there in surgery, or you're in there. I mean, do you have the mask on too?
I got to put on the mask. And I do have to give people some tough love, because another thing, people come and they want to do things that are not tax compliant. They want to take deductions that are not ordinary and necessary, which is the key term the IRS uses. It has to be ordinary and necessary for this type of business. If you have a brokerage business, there's certain deductions that are necessary and ordinary compared to someone who has a flower shop or a bakery. So people come and they want to take crazy deductions, and I'm not going to jail for you or them, and I don't want them to go to jail. So I can be aggressive, but within the guidelines of the law.
Understood. Future Wealth Builders, we are excited to have Martin Johnson, founder of Johnson Law and Tax, a firm dedicated to providing comprehensive estate planning, tax planning, and preparation services on our podcast. You can find us on Apple, YouTube, Spotify, and all of the major social media platforms. Martin, we are at the final 2 questions. This has been a learning podcast itself. I'm sure a lot of people, this probably be one of the most viewed podcasts as well in 2025. Well, again, you're dropping a lot of nuggets that's important for us to know. I mean, again, generational wealth begins with generational knowledge, and oftentimes than not, we are so focused on transferring assets, but most importantly, we have to transfer the knowledge to allow us to reach that generational wealth. So what do you want the listeners to take away from this podcast?
What's important to take away is acting now. Planning early prevents costly mistakes. You got to have a plan. The other thing is stay informed. Laws do change. From time to time, I have people come in talking to me about laws that were changed 20 years ago. I say, brother, that law changed in 2002. So stay on top of that and get guidance, get professional guidance. Even if you don't want to hire a professional on a long-term basis, it doesn't hurt to pay $400 or $500 for a consultation to make sure you're either on the right track or that you're going down the right road on a decision or a transaction that you're getting ready to make. That's what I would say. And that's what I hope your listeners can get out of this particular podcast.
So we talked about, Martin is not going to give you any financial shaming. As he mentioned earlier, he's sat in that seat as well. So with that being said, Martin, how does someone get in contact with you?
They can get in contact with me a couple of ways. First of all, they can call my office at area code 925-289-8837. and set up a consultation. I do offer free consultations for introductory meetings. If we get into some tax planning, we'll talk about that. That's one way. They can go to the website, which is www.360epi.com. That's the current website. We will be changing that with the rebranding. But at this point, telephone and website are the best ways to get in touch. And they can email too. You can email me at martin@johnsonlawtax.com.
Future Wealth Builders, we're going to have all that information in the description, in the link of this podcast episode. I hope that you enjoyed this particular podcast. This is Martin's 3rd time. 2025, this is his first time, and I'm sure we're going to have him come back later on in the year as well. So on behalf of the New Wealth Wave podcast, all of our subscribers and listeners, and our producer, Ray Haycraft, and myself, Dr. Joaquin Wallace, we'd like to thank Martin Johnson coming on this afternoon, dropping all of this knowledge, all of this information. As we always say, generational wealth begins with generational knowledge, and we'll see you on the next episode of the New Wealth Wave podcast. Thank you for joining us on the New Wealth Wave podcast, hosted by Dr. Joaquin Wallace. Our show is edited and produced by Ray Haycraft. To dive deeper into the world of financial wisdom and learn how to create your financial footprints, head to our website at www.drjwallace.com. For more updates and exclusive content, Connect with us on social media by searching Dr. Joaquin Wallace. And if you have questions and comments, feel free to email us at thenewwealthwaypodcast@gmail.com. Remember, generational wealth begins with generational knowledge. And as always, thanks for listening. The content presented in this podcast is strictly for educational purposes and should not be taken as investment advice. The views and opinions expressed by our guests may not necessarily reflect those of the New Wealth Way podcast and its host or producers. Listeners are urged to exercise discretion and judgment before making any financial or investment decisions. Always consult with a financial professional or advisor before taking any action based on the content of this podcast. If you're enjoying the New Wealth Way podcast, we appreciate if you leave us a review. We're always open to topic suggestions and guest recommendations. Feel free to reach out to us directly with your thoughts and feedback. Thank you for tuning in, and we'll see you next time on the New Wealth Way podcast.